The banks smash the paper price again. They want you to believe the rally is over. They want you to believe silver is just a speculative bubble that just popped. They are lying to you, not just a little lie. This is a lie of omission so massive it borders on criminal negligence, because what just happened was not about price. It was about rules. The banks are playing a paper game. While you were staring at the COMEX ticker, while algorithms were dumping contracts in New York, the exchange quietly pulled a set of emergency levers that traders call a kill switch. Not in a cinematic way, in a procedural, perfectly legal way, the kind of change that shows up in a notice, wrapped in risk language, and then enforced with brutal precision. And if you do not understand what that means, you are not trading silver. You are volunteering to be exit liquidity. So here is what we are going to do today. I am going to show you what the kill switch really is, why it shows up exactly when price starts to escape, and why it is the clearest signal you can get that the paper market is under stress. Then we are going to run the math that the talking heads never run. Open interest versus deliverable inventory, and why a small shift in behavior can force a huge repricing. Then I'm going to give you a simple playbook, 3 lanes, 3 different ways to position in a market where the rules can change mid-move. And finally, we are going to talk about what happens next, because kill switch events do not end a story. They reveal which part of the story the system is terrified to let you see. One quick note before we go deeper. When I say kill switch, I do not mean a single red button. I mean the exchange toolkit, margin hikes, tightened limits, intraday volatility controls, trading pauses, restrictions that turn a two-way market into a one-way exit. When the system gets stressed, those tools get used. And silver is the perfect market for this because it is small enough to be pushed around on paper, but important enough to matter in the real economy. It is monetary and industrial at the same time. It sits at the intersection of fear and necessity. That is why it moves like a beast, and that is why it gets treated like a problem when it starts to run. Now let me walk you through the trigger step by step in plain English. First, you get a breakout that actually matters. A level that has rejected price for months finally breaks. Stops get hit. Dealers hedge. The market shifts from calm to urgent. Spreads widen, volume spikes, and the move starts feeding on itself. You can feel it. The tape stops being polite. It starts acting like it knows something. Second, you get stress in the plumbing. Maybe it is a concentrated short that suddenly needs to buy back. Maybe it is heavy demand for near-month exposure. Maybe it is a thinning of available registered inventory. Maybe it is just that too many people are leaning the same way at the same time. The details change. The stress signature does not. The system starts to feel heavy, like a door that does not want to open because something is jammed behind it. Third, the exchange watches its own risk metrics, volatility thresholds, clearing member exposure, intraday margin models, and when those metrics cross a line, the exchange does what every exchange does. It prioritizes survival over price discovery. That is the kill switch. Here is the uncomfortable truth. COMEX is not a physical silver market. It is a derivatives market with a physical escape hatch. Most participants do not want delivery. They want exposure and leverage. That works as long as people behave the way they always have, rolling and netting and cash settling. But if too many people try to take the escape hatch at the same time, the system can choke. So the kill switch exists to prevent a visible choke. And the reason you should care is because the kill switch is a confession. It is the system admitting that normal liquidity is not enough. It is admitting that the paper market is vulnerable to real-world pressure. Now, the mainstream story is always the same. Silver ran too far, silver got frothy, silver needed to cool off. They show you a chart, they show you a moving average, and they tell you to be careful. That is not analysis, that is sedation. Because what you just watched was not a natural cooling. It was a trap door. It was the market in its thinnest hours, when it is easiest to shove a price around with paper, getting hit with a burst of selling that does not look like a human taking profits. It looks like a system executing a plan. Fast dumps, repeated waves, no patience, no finesse, just impact. And then, right on cue, you hear the calm voice of the narrative. You hear that it is healthy. You hear that it is normal. You hear that it is good to shake out weak hands. Yes, it is good to shake out weak hands. The only question is whose hands are being shaken. The real question is why the cooling off lines up with sudden margin schedules and procedural notices. Because the paper system is not designed to let you win a delivery race. So what does the kill switch look like in practice? So the first lever is margin. When the exchange raises margin, it is not a friendly reminder to be responsible. It is a forced deleveraging event. It is a cash call. It knocks out anyone who is long with borrowed money. It does not matter if you are right. If you cannot post cash, you are out. And when people are forced out, the sell button becomes automatic. The second lever is limits and enforcement. Limits can be tightened, exemptions can be narrowed, and suddenly a player who thought they were fine is forced to reduce. Again, it is not about truth. It is about control. It is about preventing one side of the market from becoming too confident. The third lever is volatility controls. Trading pauses, price bands, intraday breaks. These are marketed as safety. But in a squeeze, time is the weapon. Slow the tape and you let the system breathe. Stop the tape and you let hedges reset. You let risk managers call each other. You let positions be reorganized behind the curtain. And there is a fourth lever that is so toxic, it rarely gets said out loud. Restrictions that make it easier to exit than to enter. In extreme cases, rules that feel like liquidation only. You can close, but you cannot press the move. That is not a market. That is an evacuation. Now, here's the part that makes all of this click. The kill switch is not pulled because the fundamentals got worse. It is pulled because the mechanics got dangerous. So let us do the math. Do not go anywhere. The math gets scary in part 2, but it also makes everything make sense. COMEX warehouses report categories that people confuse. Eligible metal is metal that meets specifications and sits in approved warehouses. Registered metal is metal that is tagged and available to meet delivery obligations. Think of eligible as cars in a parking lot and registered as keys on the counter. The cars exist, but you cannot drive them away unless the keys are actually there. Open interest is the number of outstanding contracts. Each contract is a promise. Most of the time, those promises are rolled, offset, and closed. But in stress, promises get tested. People stop trusting paper and start asking for keys. If you have a huge stack of promises and a much smaller stack of keys, you can still function as long as behavior stays normal. That is the hidden deal. The system offers leverage in exchange for your agreement not to demand the underlying asset. But even a small change in behavior can break the illusion. Here's the simplest way to see it. Imagine open interest represents 100 million ounces of claims, and registered represents 1 million ounces of keys. That is just an example to show the mechanism, not a claim about today's exact totals. If 1% of claims try to take delivery, that is 1 million ounces. That is the entire registered pile. 2% overwhelms it. And once the market starts thinking in percents, everything changes, because percents are tiny, and the impact is enormous. Now add the human element. In quiet times, nobody wants the keys because holding keys is inconvenient. It takes capital, it takes storage, it takes logistics. So the paper system looks stable. But in a world where supply chains get fragile, where geopolitics makes shipping unpredictable, where inventories are optimized down to nothing, suddenly the inconvenience becomes worth it. Suddenly, certainty is the product, and certainty is exactly what a paper market cannot print. This is where the story gets bigger than trading. Silver is not just a monetary metal. It is a critical industrial input. Electronics, solar, grid infrastructure, advanced manufacturing. Every time you see a new technology wave, you see a metal wave underneath it. Industry does not buy headlines. Industry buys supply. When industry gets nervous, it does not tweet. It signs contracts. It locks in metal. It changes procurement quietly. That quiet shift is what the paper market cannot easily absorb, because the paper market is built on liquidity, and liquidity is built on trust. Trust that you can always get in and get out. Trust that your counterparty will perform. Trust that the exchange will remain a neutral platform. Kill switch events are what happen when that trust starts to wobble. Let me explain why exchanges behave this way, because once you understand the incentive, the pattern stops feeling mysterious. Every trade on COMEX clears through a clearinghouse. The clearinghouse sits in the middle and guarantees performance. That sounds comforting until you realize what the guarantee is made of. It is made of collateral. It is made of margin. It is made of the ability of clearing members to meet daily variation margin calls when the price moves. When price moves violently, the clearinghouse does not care about your thesis. It cares about cash today. If a short is losing, they must post cash. If they cannot post cash, the clearinghouse has a problem. So the exchange uses margin as a pressure valve. Raise margin and you force everyone to put more cash on the table. That reduces leverage. It reduces position size. It reduces the speed of a squeeze. The public hears margin was raised for safety. What it actually means is the system decided the move was too dangerous to allow on the existing leverage. And because most speculators are leveraged, the margin hike mostly hurts the long side at the very moment the long side is finally right. That is why it feels like the rules always change at the worst time. Because the rules are designed to protect the clearing system, not to reward correct forecasting. Once you internalize that, you stop taking the smash personally. You stop imagining a villain twirling a mustache. You see a machine protecting itself. And machines do not care about your feelings. Machines care about thresholds. Now layer in dealer hedging. When price rises, dealers who sold exposure often need to buy futures to hedge. That buying can push price higher, which forces more hedging, which pushes price higher again. In calm markets, the loop is manageable. In stressed markets, it becomes a feedback machine. Paper demand collides with physical tightness, and the exchange sees the possibility of a disorderly move. So it interrupts the loop. That interruption creates the thing you just lived through. A rally that should cascade higher gets chopped, stalled, slammed, and reset. Casual observers call it normal volatility. The insiders recognize it as containment. Now, if you just listened to part 2, you now know the secret the mainstream refuses to say out loud. The system is not afraid of your opinion. It is afraid of your behavior. It is afraid of you deciding that paper is not enough. Because when behavior changes, the pressure does not disappear. It relocates into physical premiums, into off-exchange dealing, into leasing costs, into supply chain hoarding, into the places that are harder to chart and harder to explain in a 30-second segment. Which is convenient because the public stays focused on the one metric that is easiest to steer. The paper quote, "That is why you should not let a paper smash convince you the metal became less important overnight. The fundamentals do not change in a day. What changes in a day is the way the game is played." So how do you play it? Here comes part 3, the playbook. There are 3 lanes. Lane 1 is physical ownership, not collectibles and fancy packaging. Weight, metal, inventory you control. In a kill switch environment, the most important thing is removing counterparty risk. Paper can be frozen, products can be gated, rules can be rewritten, metal in your possession does not care. And this lane has a simple signal system. When paper price gets hit but physical does not loosen, that is not bearish. That is divergence. That is the market telling you the quote is being managed while the shelf is staying tight. The signal is not the candle. The signal is the shelf. Lane 2 is miners. This is leverage to price, but it is also leverage to politics, costs, management, and dilution. Miners can explode higher in a real bull move, and they can collapse even when metal holds, because they are businesses, not bars. The key is to own operators that can survive volatility without being strangled by hedges or debt structures that cap upside. You want clean balance sheets, transparent management, and jurisdictions that do not treat miners like piggy banks. This lane requires patience because the kill switch volatility is designed to make you sell your leverage at the worst moment. So you size smaller than your ego wants, you diversify, and you accept that drawdowns are part of the job. Lane 3 is paper tools, but with your eyes open. Futures and options can be powerful if you respect the rulebook. That means sizing that survives margin shocks. That means structures that do not require perfection. That means expecting volatility, not being surprised by it. And it means never confusing a paper quote with the value of the metal. If you are in lane 3, your edge is not predicting the next candle. Your edge is understanding the constraints of the system. You watch exchange communications like you watch volume. You watch margin schedules like you watch support levels. You watch for language that signals intervention. And when you see it, you do not panic. You recognize that intervention is a sign of stress, not a sign of safety. Now let us talk about what happens next, because this is where most people get faked out. After a kill switch event, you usually get an immediate flush. Weak longs are forced out, stops cascade, headlines turn negative, social media flips from euphoria to despair in hours. This is the phase that makes people swear they will never touch silver again. Then you get stabilization. Volatility compresses. The market looks boring. The talking heads move on. This is when the system hopes you will forget the discomfort, because forgetting is what keeps you passive. Then you get the retest. Price drifts back toward the level that mattered. If the pressure was only speculative, the retest fails and the market collapses into silence. If the pressure is structural, the retest holds and the market tries again. And here's the key. The retest is not about price. It is about behavior. Do buyers return even after being punished? Do physical premiums stay firm? Do spreads stay weird? Do industrial players keep securing supply? Do more participants talk about delivery? That is the scorecard. So what should you watch in the next sessions? Watch margin notices and exchange communications. Watch repeated hits during thin hours. Watch physical premiums and availability. Watch whether the near month behaves like it is scarce or like it is abundant. Watch whether the market keeps snapping back after smashes, because snapping back is the sound of underlying pressure refusing to go away. And watch industry behavior, because industry is the force that does not care about the paper story. When procurement gets nervous, it turns a commodity into a bottleneck, and bottlenecks do not resolve with a press release. And one more thing, the next time you see a violent drop, do not automatically assume it is bearish. Ask one question first. Did the drop come with a rule change, a margin shock, or a procedural intervention? If it did, you are not watching a free market reject the move. You are watching a system manage the move. That distinction matters because a managed move can snap back fast once the forced selling is done. If you can stay calm while everyone else is being trained to panic, you gain an advantage that has nothing to do with predicting the next headline. Now I want to end with a reset that you can keep in your head. The banks are looking at the weekly chart. You need to be looking at the rule book. The exchange is not here to tell you the truth. It is here to clear trades and protect itself. When pressure builds, it will choose stability over discovery. So if you are watching silver and you are confused by the whiplash, stop asking why the price is irrational. Start asking what the system is trying to prevent. Because the kill switch is not a sign that the story is over. It is a sign that the story is entering the phase where rules matter more than narratives. They change the rules again. Now you know what that really means.